To close the income summary account into capital, we have to debit it as there's a credit balance currently sitting in the holding tank of $10,000, and we credit the capital account to move the entire lump sum in one shot to capital. Of course, the gentleman's capital account is going up with the credit, and I'm just going to finish off the journal entry with a brief description to close out the income summary count. So everything was moved into income summary, first the revenues, then the expenses. We were temporarily left with the net income of 10,000 sitting in income summary. As a last step, we closed the amount in income summary to capital. Looking at the note here, in this case, the capital account is Jim, capital. In a bigger corporation, as we talked about, the capital account would be retained earnings. So after the net income has been earned and moved to capital, we will have one more transaction, and this will be Jim withdrawing some money for his own use. He will withdraw half of the quarterly income in lieu of a salary. And we're going to make an entry to record this cash withdrawal. So note that a cash withdrawal by the owner can happen at any point. It doesn't necessarily have to be at the end of the quarter or end of the period. It can simply happen whenever the owner decides to withdraw money. So in this case, it happens right at the end of the quarter. So the withdrawals account is called Jim Withdrawals, and transactions happened on September 30th. It will be $5,000, half of the quarterly income. And of course, the credit will be the cash, because whenever the cash account goes down, we credited it. And brief description here, I'm just going to write down owner withdrawal. And maybe I'm going to write a brief description, half of Q3's net income. Just to give a little more detail of what's going on. Now, what this has done, it has created another account which needs to be closed. The owner's withdrawals account is another temporary account which does not show up on the income statement, but it doesn't show up on the balance sheet either. What happens is get closed into Jim, capital in this case. So the capital account will include the money that has been taken out by the owner. So now Jim needs to close out the Jim withdrawals account. Note that this account can have many transactions during a period as a debit balance accumulates with multiple withdrawals. In our case, there's only one withdrawal shown above in our journal entry. Therefore, the Jim withdrawals account must have a debit balance of $5,000 at the end of quarter 3. And here is our closing journal entry for the Jim withdrawals account. So what's going to happen here is we're going to close this one directly into capital. There's no reason to go through a holding tank with this one or income summary. What we do is we just take the withdrawals account and directly debit the capital account to recognize that 5,000 equity has been taken out of the business. So I'm going to go ahead and make a brief description again to close out the owner's withdrawals account. So that's our closing process all done. A quick final note here. Note that the debit balance in the owner's withdrawals account disappears with the credit above. The Gym Capital account decreases by $5,000 as cash is withdrawn from the firm. Because the capital account now reflects all amounts which have been withdrawn, there's no reason to include the withdrawals account on the balance sheet. And one last note about the post-closing trial balance. We can update our trial balance one last time if we wish using the updated account balances after closing entries. However, this doesn't serve much purpose other than confirming that debits equal credit and only permanent accounts have non-zero balances. We're talking about cash, AR, bank loan, common shares, those type of accounts. And because this is kind of an outdated process, there are now simpler ways to confirm that debits equal credit. I will not be examining you on the post-closing trial balance. Moving on to correcting journal entries. If an account makes an error, which is detected after posting, a correcting entry is needed. For example, assume the SFU bookstore paid $1,000 cash for furniture, but an incorrect journal entry was made. So I'm going to go ahead and make an incorrect journal entry here. May 13th, and I'm going to debit office supplies. This is a realistic error. We can confuse furniture for supplies. And we're going to say $1,000 so the amount is correct. And the credit for cash is also correct. And I'm going to write down a brief incorrect description. Bought supplies with cash. So here's our incorrect journal entry, all done. So how do we correct it? Our first step in correcting this mistake is to identify what was done wrong. Cash was paid for this transaction, so the credit entry is okay. The amounts are also correct. $1,000 was paid for furniture. However, the debit entry is incorrect. The bookstore bought furniture, not office supplies. By debiting office supplies, we increase that asset on our books. Therefore, it is currently overstated. By not debiting furniture, we are understating the value of that asset. Hence, our correcting journal entry should lower office supplies and increase furniture. The cash account should remain unchanged. Two ways to make this correction. The first method, we can make a reversing journal entry and then make the correct entry. So a reversing entry intends to undo the original incorrect journal entry. So basically, you credit your debit and debit your original credit. And the second part of this first process over here is to go ahead and make the correct journal entry. So I'll let you go ahead and try this first method. I'll also ask you to look at the second correcting method, which is a one-step correcting entry. In this method, we look at our example and note that the credit to cash was correct. It doesn't have to be undone. We only undo the actual mistakes. So think about that and have a crack at the second method too. And we will go over both of these methods in detail in the next video.